Business activities that get rejected by Dubai banks and why. One of the most common and most expensive mistakes founders make in Dubai is assuming that once a business license is approved, their bank account is guaranteed. This single assumption has delayed businesses for months and in many cases completely killed them before they can even start operating. Licensing and banking in Dubai are two completely different systems. They are not connected in the way most founders think. A license only gives you permission to operate. A bank account is a permission to exist financially. You can have a perfectly legal business and still be completely unacceptable to a bank. Dubai banks do not evaluate businesses based on ambition, potential, or future plans. They evaluate risk, and their definition of risk is very narrow. Banks care about compliance, traceability, and exposure. They want to know exactly where money comes from, exactly where it goes, and exactly why it moves the way it does. Anything that introduces uncertainty immediately raises red flag. Certain business activities automatically trigger deeper scrutiny. Crypto-related activities are the top of the list. Even indirect involvement with crypto, such as consulting, promotion, or facilitation, increases risks. Forex trading and investment advisory service face similar treatment because they involve financial speculation and regulatory sensitivity. Payment processing, fintech platforms, and any businesses that touches other people's money are considered high risk. Banks see these activities as potential liabilities rather than opportunities. Even if the business is fully legal, the compliance burden is high, and many banks prefer not to deal with it all. Digital marketing agencies often assume they are low risk, but many are rejected because their clients are international. When revenue comes from multiple countries, currencies, and platforms, it becomes harder for banks to trace the source of funds. Harder to trace means higher risk. Import and export businesses without physical operations in the UAE also face challenges. If there is no warehouse, no inventory, and no local footprint, banks struggle to understand how goods actually move. This lack of physical presence creates suspicion, even if the business is legitimate. Consultancies without signed contracts are another major problem. When revenue is based on services without documented agreements, banks see the income as unstructured. Unstructured income is difficult to audit, difficult to explain, and therefore risky. Cross-border payments amplify every concern. The moment money starts moving across multiple jurisdictions, the moment money starts moving across multiple jurisdictions, banks become cautious. Different regulations, different compliance standards, and different enforcement rules increase exposure for the bank. It is important to understand this clearly. Banks are not rejecting businesses because they are illegal, they are rejecting businesses because they are unclear. The single biggest reason for rejection is unclear, the source of funds. If a bank officer cannot explain your business in simple terms to a compliance team or regulator, your application will not move forward. If they cannot clearly see where money originates and where it ends up, they will stop the process. Another major mistake founders make is poor activity description. Many people copy license activities from friends, agents, or other templates. Others choose generic wording that sounds broad and flexible. This backfires. Generic descriptions raise questions. Mixing unrelated activities under one license create confusion. Confusion equal risk, and risk equal rejections. For banks, clarity is everything. They prefer businesses that are boring, predictable, and easy to understand. Local clients, clear invoices, simple revenue models, straightforward transactions. Predictability is valued more than innovation. This is why some founders are shocked when a basic trading company gets approved instantly while a modern digital business struggles for months. The issue is not fairness, the issue is simplicity. When a business is structured correctly, documented properly, and positions clearly, banking becomes much easier. This does not mean changing what you do. It means explaining what you do in a way banks can accept. In Dubai, banking success is not about convincing the bank. It is about removing uncertainty before the bank even asks questions. The problem is rarely the bank. The problem is preparation.